Why doesn't a company expense long-lived assets as soon as it buys them? In this video, I explain the capitalization of property, plant, and equipment, how depreciation is the process that allocates the cost of these assets from the balance sheet to the income statement, and why market value is not the same as book value. This video, I will describe the treatment of long-lived productive assets. These are the resources that the firm acquires with the intention of using them over multiple periods in the future. Importantly, these are not acquired solely with the intention of resale. Does that mean that the company can never sell them? Absolutely not. In a future video, we will talk about a situation that, for whatever reason, the company wishes to dispose of the assets, they no longer need them. That is perfectly acceptable. But importantly, at the time that they were acquired, they were not acquired solely with the goal of selling them. They were instead used as part of the operations of the business. In this video, we're going to focus on tangible assets, so the assets that we can actually touch. And in future videos, we will discuss intangible assets that don't have a physical nature. The other terms for tangible assets could be fixed assets, property, plant, and equipment, PP&E. Those are all commonly found in the financial disclosures. Then they all reflect long-lived physical assets. This is a very wide category. It includes a variety of assets, things like land, buildings, machinery, furniture, computers, anything that is physical in nature and is likely to be productively used for multiple periods. When we acquire a long-lived tangible asset, we reflect it on the balance sheet at historical cost, meaning we add it to the balance sheet at the amount that we have paid to acquire it and to get it ready for operations. What does that actually include? Well, of course, it includes the purchase price if we have purchased the asset, but it doesn't just stop there. Any additional taxes and fees, commissions that you have incurred in order to get this asset, that will be included in the cost as well. Any improvements that you needed to do to the assets, any repairs that you needed to do in order to get the asset ready, those will be included in the cost as well. This actually differs from the treatment that we're going to apply to repairs once the asset is in operations. In the next video, I will talk about repairs and maintenance, among other topics related to long-lived assets, and this is going to come up again. But right now, we're talking about what you're doing with the asset before it actually becomes productive for you. In that situation, repairs and improvements would both be included in the cost of the asset. Anything related to transportation fees, legal fees, all of that. So we are keeping track of everything, all the costs that we're incurring in order to get this asset ready for operations. That's also going to be offset by any proceeds that we had to dispose of things in order to get this asset ready. So a lot of the acquisition of assets are some type of a SWAT where we're getting rid of an old asset and introducing a new one in its place. Any proceeds from the sale of the old asset would go to offset the historical cost of the new one. We do have some industries, railroad, transportation, among others, that construct their long-lived assets, and the intuition remains the same. They need to keep careful track of all of the costs that they are incurring in the construction of the asset. So the direct cost, labor, material, variable overhead, fees and charges, as well as the indirect cost, the allocated overhead. So those are going to be kept track with, everything until the point where the asset is able to be put in production to be part of the operations of the company. If you have watched my introductory video, then you have seen this chart. And if you haven't, I strongly encourage you to watch the introductory video. They have a good amount of information in terms of the basics of the balance sheet and the income statement. This slide highlights the basic intuition in terms of how we think about costs and whether they need to be reflected on the income statement immediately or at some point in the future. Whenever we acquire some resources and these resources cost us money, we have to think about when are we going to get the benefit from these resources? Are we going to receive the benefit immediately? If the answer is yes, then we're going to immediately reflect them as an expense on the income statement. For example, the electricity fee that we pay for running of our operations for this month. There is no future benefit. It only helps us to operate immediately right now. So this electricity is going to be included in the electricity expense and other operating expenses in the same period. However, sometimes we acquire resources that do not benefit us immediately, in which case first we have them sit as an asset on the balance sheet, and only at a future date when we realize the benefit from them, we recognize the associated expense on the income statement. How does this chart relate specifically to long-lived assets such as property, plant, and equipment? When do they provide us a benefit? When we buy a tractor, when we buy a building, does it immediately provide us a benefit at the same period? Well, not necessarily. Let's suppose you buy something on December 31st, you're not going to receive any benefit in that specific fiscal year. So first, when we're buying this asset, we're going to reflect it as a long-lived asset on the balance sheet. And then over time, as we're benefiting, as we're using this asset, then we're going to recognize the expense. And the expense here is going to be the depreciation expense. So the depreciation expense is simply the allocation of cost of the asset from being reflected on the balance sheet to being reflected on the income statement. And just to harp on this a little bit more, because this idea of capitalization and expensing is really important when it comes to long-lived asset, and it is going to come up as a big distinction between tangible and intangible assets. The basic conceptual guiding question that one has to ask themselves whether to capitalize something or whether to expense it is A, is the asset owned or controlled by the entity? And B, can the asset be reliably and verifiably linked to future benefit? In the videos discussing the intangible assets, we will come back to this question and we will talk about the fact that when you are spending on research and development, when you're spending on marketing, you are certainly hoping that you're going to receive future benefits. You're hoping for a patent, you're hoping for brand recognition, but you really cannot be certain. You cannot reliably and verifiably link things such as R&D and marketing to future benefits. And that is a big distinction between intangible assets and tangible assets that we're talking about today. When you are purchasing tangible assets, you typically know exactly what you're going to use them for. So when you're buying a truck, when you're buying computer, when you're buying furniture, you know that you're going to integrate it in your business and it will be reliably and verifiably beneficial to you over the period over which you are using it. That's why we're going to capitalize them. We're not going to hit our income statement with the entire cost of buying the asset. We're going to match the usage of the asset with the expense as it shows up on the income statement. So the decision to capitalize impacts the earnings today because we do not have immediately an expense, but it also impacts the earnings in the future because we will reflect depreciation expense that will reduce our profitability over the period when we're using the asset. On the income statement, we have a depreciation expense, which is just a systematic allocation of the original historical cost of the asset over the period over which the asset is going to be used. This is an income statement item. Now, what do we have on the balance sheet? We don't reduce the asset value itself. The historical cost stays the same, but instead we have an account called accumulated depreciation. So accumulated depreciation is simply a mathematical sum of all of the depreciation expense that we have recognized on the asset to date. This is a contra asset account. I have introduced contra assets in a prior video on accounts receivable when we talked about allowance, which offsets the gross accounts receivable. Here, the parent is the gross PP&E, which is just the cost of our long-lived asset, and the contra asset reflects how much of the original cost has already been reflected as an expense on the income statement. Again, just as a reminder, the reason that this is a contra asset, the reason we don't call this a liability, is because accumulated depreciation is not independent. Its only goal is to offset the parent account to reflect how much of the cost has already been recognized versus how much remains not yet expensed. What the firm will reflect as an asset on the balance sheet is the net property, plant, and equipment, net PP&E. We can also call this the book value of our tangible assets, the book value of PP&E, and that's comprised of the parent minus the child account. So we have the gross PP&E, the cost of the asset, minus the accumulated depreciation. On the balance sheet, we will show the difference, and that will reflect how much of the original cost has not yet been depreciated. It's important for us to separate the way that we talk about and we think about depreciation in the accounting framework from the way that maybe we talk about it in our everyday language. In my daily life, if I talk about depreciation, typically what I mean is a decline in value. We talk about something depreciating, meaning it's less valuable. But that is not how we mean it in the accounting framework. The book value of the asset, which is the original cost minus how much we have already depreciated, does go down over time, but it doesn't go down at the same rate as the market value drops, as the fair value of the asset drops. The book value of the asset doesn't equal the value that you could get if you were to go out and sell this asset to someone else right now. It only reflects the costs that have not yet been expensed. It's really easy to see this illustration when we're thinking about cars. When we think about the market value of cars, they tend to drop sharply in the earlier years, and then they kind of level off. The market value of a car that's 15 versus 16 years old doesn't really experience as big of a drop as the drop from year 2 to year 3, etc. However, if we are depreciating this car on a straight line basis, which is by far the most common methodology, and I'm going to talk about that, what we see is that the book value just goes down at a smooth rate over time, and over the duration of much of the life of the car, we might see a book value that's actually higher than the market value. So again, for other assets, we could actually come up with situations that the book value is lower than the market value, but importantly, it doesn't really matter. We do not care about the market value when we're going through the process of calculating depreciation and recognizing the accumulated depreciation growing every single period. It is very systematic. It is very mechanical. Depreciation expense doesn't reflect the drop in the value of the asset. It only reflects the systematic allocation of the piece of the cost from being an asset on the balance sheet to being an expense on the income statement. How do companies measure depreciation? We have one item that we know for fact, which is the total acquisition cost, and then we're going to need two estimates. First, we're going to need the estimated residual value, also known as salvage value. When we get to the end of the useful life of the asset, what do we think we're going to do with the asset? Do we think that it's going to be worthless, in which case the residual value is going to be zero? Or do we think that we're going to be able to sell it, maybe sell it for scrap, or maybe even sell it for some reasonable amount because there is an active market for secondary assets like this? So we're not going to depreciate the estimation of the residual value because we expect to get it on the tail end. The other estimate that we have to make is an estimate of useful life. How long do we think we're going to be able to use this asset? This might be in terms of years, and that's what I'm going to show in the next couple of slides, but it could also be in units of output, miles driven, etc. Both the residual value and the useful life are estimates. They're done at the point where you acquire the asset and put it in production. But of course, it's possible that these estimates need to be revised in the future. So in the next video, I will talk about the situation where the asset is being used, but at some point the residual value or useful life or both of them need to undergo a revision. What happens then? The final point on this slide is that we could have assets which have a indefinite useful life, meaning that we don't expect them to ever stop being useful to us. In the physical assets, we don't have as much of these because just by sheer nature of wear and tear, most physical assets do depreciate. But of course, land is an example. If we expect land to be forever useful to us in the same way as it is when we purchase it, then we're simply not going to depreciate it. We're not going to allocate the cost onto the income statement. It will just stay on the balance sheet at whatever the historical cost at which we purchased it and readied it for operations. Let's illustrate the most common methodology of depreciation calculation, the straight line methodology. Suppose that a firm buys a truck on January 1st of 2017, and I just did January 1st to not deal with partial years for now, although dealing with partial years is very easy. We would just pro rata recognize whatever the depreciation if we bought it in the middle of the year. But let's suppose they buy it on January 1st. The cost of a truck is $43,000. We're estimating that the residual value will be $3,000 after we drive it for 10 years. So our estimated useful life is 10 years. So our depreciable cost, also known as depreciable base, that's the amount that we will need to allocate two expenses over the life of this truck, and that's going to be $40,000. And we're going to allocate it as an expense over a course of 10 years. How are we going to reflect the process of depreciation on the financial statements? On this channel, we do not deal with debits or credits. We do not deal with bookkeeping. Instead, we think about how a transaction impacts the income statement and the balance sheet over the period when it occurs. Every year, we will have a depreciation expense of $4,000, which is just the $40,000 spread over the 10 years. That will reduce our profitability every year. That will reduce the retained earnings every year. So that part from profitability to retained earnings, that's a mechanical relationship, of course. And then we will increase the accumulated depreciation, which is a contra asset account that offsets the parent gross PP&E every year by $4,000. Notice we don't actually touch the asset account itself. That was added at $43,000 when we bought the truck, and that's not changing. Instead, we are increasing the contra asset accumulated depreciation, which reduces the total assets because of its contra nature. This is something that we're going to recognize every single year. This is a simplification. In reality, the company would actually recognize it every quarter if we're in the quarterly reporting frequency in the amount that's equal to just 1/4 of that. Let's pull all of these years together. When they buy it, the book value, which is the gross PP&E minus accumulated depreciation, is just equal to the cost. It's $43,000. And then every year we have depreciation expense, which is equal. That's the nature of the straight line method. It's the same expense every single year. So the accumulated depreciation would increase by $4,000 every single year. And correspondingly, the book value will go down. Now, remember what I just said. The fair value of the truck probably drops from 43 to below 39 in the first year because we tend to have a more sharp drop for these types of assets earlier in their lifetime, but it doesn't matter for us. We're just following the straight line methodology. When we get to the end of the useful life of the truck, at this point, we have accumulated depreciation, which is equal to our total depreciable cost, $40,000, and the book value is equal to the expected residual value because, again, that was part of our mechanical calculation. What happens if we decide to sell this truck either at the end of the 10 years or maybe even earlier, and maybe we don't get the number that we expect that matches to the book value? I'm going to discuss the gains and losses on the sale of tangible assets in one of the future videos. This was a basic introduction to the capitalization of long-lived tangible assets. In the next video, I will talk about methodologies that are not the straight line methodologies, as well as have a brief discussion on what happens when we need to revise our estimate of useful life or residual value, what happens if we're dealing with continuous spending on the assets, such as repairs and maintenance or capital improvements. I hope you enjoyed the video and found it useful. Please like, subscribe, drop me a comment if you have questions or topics you'd like me to tackle next. Tell your colleagues and friends, and I'll see you in the next one.